All right. Hey, everybody. Welcome back to Dividend Stockpile. You all know that I love to bring you innovative and unique ETFs. I'm here with Barry Martin, Senior Portfolio Manager at Shelton Capital Management, to talk about their brand new income ETF, SEPI, or SEPI, the Shelton Equity Premium Income ETF. This ETF has only been around for 2.5 weeks or so, but it offers a very unique approach to options income that I wanted to share with the community. So with that, Barry, welcome to the channel.
Thanks, Jeremy. Appreciate you having us on.
Absolutely. I was super excited when I did a little bit of research on your fund and saw what you guys have to offer. I wanted to reach out as soon as I could and get you on the channel to talk about this great ETF with the community. We're all about income investing here, dividends, dividend stocks, dividend ETFs, high income ETFs, option selling, pretty much everything income related. So your ETF, which we're going to talk about today, fit in perfectly. So we're super excited about this one. So before we start getting into SEPI, can you give us a little bit of background on yourself and a little bit about Shelton Capital Management?
Yeah, well, Shelton Capital Management is a boutique asset firm located in Denver, Colorado. Okay. We've been in the business for a while now, since 1985, and we run a bunch of different strategies. Me and my team, we're in charge of the option overlay strategies, where we have over 2 billion AUM. Okay. And that's a combination between basically three things. We have the mutual fund, which just hit $1 billion last week, so that was a big moment for us. The symbol's EQTIX, and that's as a production as right now is a 5-star Morningstar fund, so we're really happy about that. And then we have separately managed accounts, which is basically portfolios that's similar to the mutual fund, and also some concentrated position with option overlays. Yeah, but so we're mainly focused on option overlay strategies, focusing on distributions, yield to the clients through option selling of options. Myself, I've been in the business for close to 30 years now. Don't mean to age myself here, but started in the late 90s as an options trader, then moved to portfolio management from there. And I've been at Shelton since 2007. It's been a really good ride for us.
That's awesome. So thank you for that background. So Shelton Capital Management, again, has been around for a very long time, and you guys have been running these strategies for your other clients in the mutual fund. But now we're just launching this new ETF so that more of the general population can take advantage of your strategy. So I'm super excited about that. Can you guys give us a high-level overview of what SEPI is all about?
Yeah, so it's very similar to our mutual fund and our separately managed accounts. In fact, as you mentioned, the ETF opens up a lot of availability for this product. Some people like mutual funds, some people like separately managed accounts, and some people like ETFs. So this is really like the third leg to our stool. Nice. So we're really excited about that. But what we're doing on a 10,000-foot level is generating additional cash returns by monetizing the volatility of the underlying positions, and we do that by selling covered calls. Mm-hmm. How we differ from some of our competitors is that we're buying individual stocks and selling individual calls. So you'll see some competitors and some people in our space that are buying index level holdings, selling index calls, or maybe picking a basket of stocks and selling index calls, or you see now, one position and then selling calls on that one position. We're a diversified portfolio where we're buying equities and selling calls. We believe we're buying the best stocks in the S&P 500 and to sell covered calls on. So we were similar weighted to the S&P. So same weightings, but in each sector, we feel that we're buying the best stocks in those underlying equities to sell covered calls on. So we're active on the stock selection portion, but also active on the option side too. As you have experience with options, is that when you own a stock like Apple, you have many decisions to make on the call to sell. And so what we're doing is we're active on those call selections. Volatility is a big factor, time's a big factor, the strike price is a big factor. So we're active on those type of things. Well, you see some of our competitors just might just sell, hey, we're just going to sell 2% out of the money 30 days out, and maybe 60 days out, 90 days. No, we're selecting the time, the strike, and what we believe is the best option to sell at that time. So we're active on the underlying equities and then active on the options as well.
Yeah, that's what I really liked when I was researching your fund is, to your point, a lot of the other ones either are using an index approach and then writing options, and that's what they focus on is the option side of it, but they don't really talk about the underlying portfolio. or they're investing in a ETF and doing options on the ETF. So there's not a lot of active management, even though they call themselves active manager. But what you guys are doing is you're picking the individual stocks, you're doing the research on the individual ones, picking the best that you can find, and then being very active on the option strategy as well. So it's like a double bonus, if you will, in my mind at least. So that's what I really
agree.
Okay.
Yeah, and
awesome.
our performance has shown, if you look at the performance of EQTIX, once again, 5 stars, Morningstar, good performance, a good distribution, and then also solid from a risk-adjusted return metrics. With our beta is lower, our standard deviation is lower than the S&P. So we feel that we're doing the best of both worlds, with the underlying stock selection and the call writing portion of it as well.
What led you guys to want to bring this one out?
Yeah, I mean, a lot of it is demand of our existing clients. As we mentioned before, people now are gravitating towards ETFs for various reasons. Whether it's they're easier to trade, they're a little bit cheaper, the liquidity's there, and so ETFs obviously become very, very popular in our space. So we wanted to add that to our repertoire of products, really because of demand. But also, I mean, we have a long history of Shelton Capital has a long history of being in the business. And I think it's just an evolution of what we're doing and what we're going to do next. And so it really combines a couple of factors, but it just makes a lot of sense, especially this type of market. As we know, there are volatilities around. We see it every day. And what we're doing is we're selling that vol and really taking advantage of that, and creating a distribution for our clients. I think a lot of it too is also demographics. We have our baby boomers that are approaching retirement or in retirement that are looking for something like a solid distribution yield, and we provide that. But also, they're looking for something like a risk mitigation strategy for owning equities. And I think it's another appropriate way to use this product. And that's how I use it. I don't necessarily need income from my portfolio, but what I am looking for is maybe a smoother ride. And so that's what this does as well. If you look at our standard deviation.
To your point, some people want the added income. They're not happy with the 2 or 3% dividend yield that you can get on your standard dividend ETFs right now. Right. But they also want a little bit of the downside buffer, and that's what the premiums can offer. So even in a down market, you're still getting that income, which can soften the blow of the downside on a little bit. So I think it's a really good package. We mentioned offline that, I'm a dividend investor and I also write options, and that's what I do for my portfolio. So what you guys do is almost identical to what I do personally. So I really love the strategy. So with that, let's dig into the ETF a little bit more. So it's SEPI or SEPI. You guys launched it about 2.5 weeks ago on September 8th. There's 40 to 50 holdings on average.
Yep.
And you guys have a really reasonable expense ratio. It's only 0.54%, which compared to some of the competitors out there is about half. And on your website, you say there's 3 main things: is cash flow generation, active management, and professional options management. So I think that encapsulates what I know about the ETF pretty well. Anything you want to add on that?
Options have become very popular because it becomes another tool in the toolbox for investors. Yeah. It's a good way to enhance the distribution of underlying equity, but it's also, we mentioned before, a good way to dampen that volatility. So you're back in the day, you're kind of stuck doing certain things, but these avenues have opened up, and so people are more familiar with it. Also, I think the costs have come down dramatically. Like I mentioned before, I've been doing this close to 30 years. It used to be really expensive to run the strategy, and so people are now using it. And obviously we had the meme craze where people are using options. We don't go, as we're doing covered call writing, we're not buying naked calls. We're not doing any of that stuff. So we're kind of on the bottom level from options approval, from a compliance angle, where we're just doing everything married and covered. So it's a very conservative approach, but people, because of the meme craze and the education and the pricing has dropped dramatically, it's become very popular, and I think it fits what we're doing. So
yeah, and going back to what some of the other ETFs offer, and I'm not going to name names, but some of them with the 50, 75, 100 something % options distributions,
Yeah.
May or may not be sustainable. Let's just leave it that way. But what your guys' approach is a much more conservative approach.
Right.
You're picking top quality names. You're writing conservative covered calls on them, and you're allowing for some upside appreciation as well in the underlying holdings. You're not going for the top distributions, if you will, like some of the other ones are.
And I think that's a big factor.
Yeah.
So I look at more of a conservative approach to owning equities. Granted, I think technically we're probably more blended. So you'll see some, dividend paying, steady owning stocks, but you also see some of our equities are a little bit on the growth side, but we'll own NVIDIA, right? So NVIDIA is in the portfolio. But it's, NVIDIA is doing very well with earnings. So it's kind of that other side of the coin. So we'll have some names where the option premium is a good amount of the distribution yield. And then we'll have some names where the dividend is actually more than the option premium.
Yep.
So we have a blend here, and it really depends on the sector that you're in, and the underlying equities inside of that sector.
Yeah, totally.
But I really believe, like, from a stock picking purposes, if I want to use an analogy, speed limit 65 miles an hour, I'm driving 50 trying to avoid potholes because of the asymmetric returns and the downside risk. And I think that's how people, if they write covered calls, I think that's a good approach. Is Goldman Sachs did a white paper a couple of years ago where they did factor analysis on superior covered option writing. And the number one factor that came back was actually free cash flow. So stocks that generate free cash flow tended to perform better from a risk-adjusted return metrics than others. Okay. So that's something to think about. Also, stocks, large cap equities tend to perform better as well. And so those are the type of things that, obviously it's confirmation bias from what I've been doing for, 25 years, but that's how things play out is that you have to manage that downside risk and not be too aggressive on the call right. Because, you want some upside. So we write a little bit further out of the money. So I would like to, depending on volatility, get maybe 5 to 10% out of the money, and stick to shorter dated calls. Yeah. And the reason why we stick to shorter dated calls is time decay. So I don't know if your listeners are familiar with time decay, is that if you sell an option for $1, that's 30 days out, and the stock remains pretty much the same price, it will stay at $1 until you get to about 20 days out. And then at 20 days out, it starts to drop off like a table. So it goes from $1 to zero pretty quickly 20 days in. So we like to get shorter dated call sales out. That certainly makes sense.
Let's talk about some of those holdings right now. So obviously subject to change, but you have Apple, Caterpillar, NVIDIA, as you mentioned, Microsoft, Alphabet, Amazon, Broadcom, Meta, all the big ones. If any one of these would be considered a top class investment. And then you have your options writing on most of your holdings, if not all of them. And I see that most of them right now are dated for about October 17th. So, 30 to 45 days out from when you guys started. Now, with the calls, do you allow them to get assigned, or do you roll them over if needed?
Yeah, so we do a little bit of both. Typically, if we like the stock, we'll roll it. And so we have as you mentioned at the beginning, we have a balancing act between the distribution that we're achieving to generate, but also upside of the portfolio. I mean, at the end of the day, I look at total return.
Yes, you have to.
Yes, we can generate option premium, and that's an important number, but total return is important. And so we have this balancing act of the upside and the cash flows generated from selling the calls. So if something goes in the money and I like the stock, let's say it goes $5 in the money, I'll probably spend that $5 to buy it back, and then maybe get $5 going forward, but lift the cap from, let's say, if the stock's 100 and it goes to 115, so I buy back the 110s, and then maybe sell the 120s 2 months out or 30 days out, depending on the volatility, and get that $5 back. We're doing that across the board. If the stock is no longer ranked in our top quartile on our screening process, then we'll likely let it get called away and then replace it with whatever's next in the list of our screening process. So I think that's important, is that you want the flexibility of rolling things, and not necessarily just getting always called away, because sometimes that doesn't play out. So we're kind of balancing both of those. And if the stock still remains in a solid pattern and where we like it on the screening process, we'll try and roll it up and sacrifice the distribution to get some appreciation of the underlying equities.
Yeah, that's why I really like your active approach to it, because you do take those into consideration. It's not just a one strategy and you let it get assigned or you roll it over. Like you guys are able to pick and choose to find, to your point, that total return, which is the most important should be for any investor, but especially for those who are looking for steady income over time. I
Right.
know that this ETF's only been out a couple of weeks, but do you guys have any kind of estimate or guidance on what kind of yield you're expecting on this particular fund? Can you talk about that?
Yeah, so it starts off like we won't know until October when
Yeah.
all those options come due, and so our goal is to, like, our mutual fund and our separately managed account is a range between 6 to 9%. That's what
Okay.
we're trying to do,
Yep.
and it's really dependent on volatility, and how we get there. So it's kind of like, it's a kind of a wait and see approach of how we get there, and then we'll get to the point a year from now, and then we'll have a really solid view of it. But our guess is it would be similar to the mutual fund, which right now is paying around 9%.
Okay.
So and we'll be happy with that.
Yeah, and it makes sense because options, premiums that you were able to receive, or the timing of everything, it really depends on every single month or every single quarter. So, so you just have to kind of wait and see what the distribution is going to be. But as an investor, you should want that. You should want a flexible approach. Some months you might have better capital appreciation. Other months you might get more distribution. So it all balances out in the end. And if you're getting the total return and a decent yield, I mean, that's all you can really ask for. So where can people find more information about SEPI and Shelton Capital Management?
Yeah, so we can go to our website, or sheltoncap.com, and then you can obviously search out SEPI, SEPI, and then also you can, a good thing too is just look at our mutual fund, because it's not an exact clone of a mutual fund, but it's similar, and the symbol in that is EQTIX. So if people are more into the mutual fund world, that might make sense as well, and that has a nice track record that you can look upon. And so, those are kind of the three places. So really excited about this. The demand has been great. It's been a good launch. And yeah, we're just really excited.
Yeah, I mean, you guys have put together a really good package. You guys have the history behind you with the separately managed accounts and the mutual fund, and you guys are rolling out a similar strategy. So I expect only good things for you. Thank you so much for coming on, Barry, talking about this new ETF and about a little bit about yourself and your company. I appreciate your time, and hopefully we'll be able to talk real soon.
Yeah, thanks, Jeremy. Really appreciate it.
I appreciate it. Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.